Hello everyone and welcome to my channel. In this video we're going to talk about one of the most intriguing tech companies that has been trading on the Nasdaq, Canoo Inc., trading under the ticker symbol GOEV. It has been one of the rising stars of the 2020 era, when the EV seemed to be on the verge of taking over the universe. This is obviously not how things have played out eventually, and today many people are wondering if there's any possibility for Canoo to recover to its former glories. In this video, we're going to talk about Canoo, its recent price actions, the technical aspects, and the best trading approach given the circumstances. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Canoo recently entered the revenue generation phase, with management accelerating the efforts. They're set to deliver the first batch of units in a 1,000 unit agreement with the state of Oklahoma. Now, here's a little catch. Up to 1,000 units. Often companies use that flexibility to make great announcements to attract investors, even if the actual deliveries may not be as much. It's a common tactic that we've seen in the EV industry. So, to secure its financial position, Canoo has decided to raise $45 million in a preferred stock and warrant subscription. This is vital because, despite raising over $1 billion from the investors, the company is currently very low with cash. This injection brought their cash balance to around $53 million in September 30th, which prevented a potential cash crisis. Now, here are the quick numbers. Canoo stock has been plummeted by around 99% from its 2021 peak. In the most recent quarter, the company burned through $61.9 million, which is a significant improvement from its worst point when losses reached around $120 million per quarter. The upcoming quarters are critical as Canoo gears up for increased sales, aiming to curb these cash outflows. The real excitement comes from the revenue growth projections, as estimates suggest a minimum revenue of $1.4 million in 2023, skyrocketing to $268 million in 2024 and $1.25 billion in 2025. These figures, if achieved, can make Canoo an attractive investment, but the road to these targets has plenty of risks, given the challenges faced by many new EV companies in production and delivery. Despite the promising revenue forecasts, analysts are predicting a loss of 41 cents per share in 2024, improving to a 20 cents loss per share in fiscal 2025. The gross profit margin is expected to be a modest 4.4% in fiscal 2025, a step toward profitability. It is crucial to remember that Canoo is still relatively early in its development, and patience is still required as it navigates the complexity of the EV industry. Looking at the balance sheet, Canoo sits currently at around $56 million in cash and carries $82 million in long-term debt. With a burn rate of nearly $62 million per quarter, the company's position still remains fragile. There's also been significant shareholder dilution, with shares outstanding jumping from around $150 million to $621 million, reflecting the substantial stock issuances to finance the company's growth. With that being said, here's a quick look at the technicals. The trading volume of Canoo is recently around 33 million shares, compared to an average volume of 33 million shares. Over the previous 52 weeks period, the price fluctuated between 22 cents and $1.47. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but the low liquidity could mean that the demand being limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Canoo is currently around $180 million. As we compare the current price to the historical price fluctuations, the stock is 12% higher than the 1-month low, 15% higher than the 3-month low, and 15% higher than the 52-week low. On the option market, which often gives us a hint about the market sentiment on where the stock price is probably going to go next, the implied volatility is 283% compared to a historical volatility of 94%. The put-call volume ratio is currently around 2%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is around 2.7 thousand contracts a day versus the 30-day average of 3.6 thousand. Regarding the open interest, the most recent volume of open interest is around 445,000 contracts versus the 30-day average of 432,000 contracts. In terms of the shareholder structure, institutional shareholders own about 11% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Typically, it's encouraging to see some institutional participation, although in this case, it's really not much. They would offer a layer of stability and a token of reliability if the company isn't having significant cash issues. So I would personally consider the minimum threshold to be around 30% for any stock to be investment grade. So in that case, Canoo may not be one of those. The current short interest is around 20% of the total float, and 44% of the transactions come from the dark pools. Typically, if the short interest is around 15% of the total volume, and a significant portion of the shorts come from the dark pools, it could suggest that there are institutional positions taken to short the stock, and there would be potentials. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and if possible growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. Of course, there's a lot of reasons to buy Canoo to make it part of your portfolio, but long-term holding shouldn't be one of them at the moment. If the objective is to have some limited exposure into one of the more speculative side of the EV market, then perhaps a stock like Canoo might suit your needs. Otherwise, there are plenty of other choices in the market to consider for a safer, more sustainable investment option. I would recommend to commit between 0.5 to 1% of your portfolio in Canoo and to split it in batches of 20% to benefit from any potential pullbacks.